Welcome, ladies and gentlemen. This is the Real Estate Expert webinar series from Weekly Real Estate News. Let me start in just a minute or so, give people time to move on into the room. Got a great program for you today, and we're very glad you're with us. All right, folks, welcome to the program. I'm Rick Grant. I'm the editorial director for Weekly Real Estate News. I want to welcome you to today's program. Now, we had this gentleman on about a month ago, and he did a fantastic job of adding real value to our subscribers. And if you've been reading Weekly Real Estate News for any length of time, you know that's our primary mission. Everything we do is designed to help you be more successful, and today's program is no exception. We're going to be bringing you, well, you may know him as Mr. Title and Escrow. We call him Trent Hendry, and you are really going to love what he presents today. He's going to give you an idea, a technique, a strategy that will allow you to get home sellers off the fence and into the game. And with the changes we're seeing and that we anticipate for next year, this is definitely the time to be learning about these strategies and getting ready to put them into play in the coming home buying season. Now, in a minute, I'm going to turn you on to Trent Hendry, and he's going to be interviewed today discussing this new technique and more with John G. Stevens. John Glenn Stevens is the publisher of Weekly Real Estate News, my partner and an industry insider that's been in our industry for a long, long time. He leads a great discussion, and you're going to love it. So, John and Trent, when we come back. And you guys are live. I'll let you take it from here.
Sweet. Hey, John.
John, can you see us, hear us? Did we freeze up? Trent, you may have to talk to me today.
That's fine.
That's okay. I would love it. John, tell us if you can hear us yet. How about now, John? Can you hear us now? No. All right, Trent, why don't you tell us a little bit about your background, where you came from, and what you're going to be talking about today?
That sounds good. So my name is Trent Hendry. My background is I've been in title and escrow for, going on 24 years now. So I grew up in the business. My dad owned his own title agency for up until, it was about 43 years, up until January of last year. And then we were acquired by a large nationwide underwriter. So I began the business on what we're going to talk about today, learning and putting closings together with seller financing. Kind of an abnormal way to learn the title and escrow business, but that was a large part of the type of closings that my dad did. And so as being his assistant, his escrow assistant, that is what I stepped into. And in my family, it's what we call baptism by fire. Just feed them to the wolves. And so I learned seller financing at an early age in my career. And that's what we're going to discuss, big family history. So that's a little bit about me.
I love it, Trent. Now, John's going to be back with us. He's having some technical difficulties that he'll solve in a minute. And when he gets back, I'll turn the floor over to him. But in the meantime, I want to get you started, start sharing this information. You gave us a set of slides to work with, right?
Yep.
So we'll pop those up. I'll get out of your way and let you present them.
Okay, awesome. Thank you, Rick. So talking today about seller financing, again, one of those topics that I'm passionate about. I've got a handful of those in the title and escrow world. And again, because I started doing these at such a young age or early in my career, it's been something that I've, over the years, obviously done a lot of transactions with, got a lot of experience with, and love helping people walk through these kind of more abnormal, not your typical, a little bit more difficult kind of transactions. So let's go to the next slide, Rick, and let's talk about the types of seller financing that we have. So we can give you a little bit of a baseline and lead into how these can help increase your sales, whether you're doing listings or showing homes to buyers and whatnot. So we've got 3 listed here. 2 of them are very similar to one another, but different in nature. So let's first talk about contract for deed. Now, these may have different labels across state lines, right? So here in Utah, we call it contract for deed. It was back in the old day, it was called uniform real estate contract. So this is a type of seller financing where the property is going to be sold from the seller to the buyer on a contract. So there's no note signed with this transaction, and it's a contract between the buyer and the seller that says buyer is going to pay to the seller, whether it's on a monthly basis, semi-annual, annual, any type of payment terms can be negotiated with these, but they're going to make, let's say, monthly payments for simplicity. They're going to make most monthly payments to the seller. And after, say, 5 years, 10 years, once they've paid the contract in full, that's when they would take title to the property. So this is where the seller is going to stay on title to the property throughout the period of that contract being in existence. Payments typically are made to an escrow company. Most seller financing, I'm going to recommend that you use an escrow company for manage of the payments between the buyer and the seller. Now, there are circumstances and situations where it's okay for the buyer to make the payment straight to the seller, but most of the time, that's going to be recommended to go through an escrow company, really for protection and liability purposes. So when we do these, because the seller stays on title, there's typically what's called a notice of contract or a notice of interest that's recorded on the property to show that there is a contract between the buyer and the seller, so that the seller can't just sell the property out from underneath the buyer after they've gone under contract, right? And then there's a deed held in title to transfer title from the seller to the buyer. Once the contract is paid in full and fulfilled, it's held by the escrow company, the same company that the payments are going through. And then once that contract's fulfilled, that deed can be released to the buyer to record the deed with the county recorder's office and officially take title to the property. So the other one is, the next one is a note and deed of trust. So these next 2 are pretty much going to be the format that you see retail lenders, banks, credit unions, all of them structured, unless you're in a state where they primarily deal with mortgages. I know that there are some out there. I'm not overly familiar with closing mortgages, because here in Utah, it's pretty much all deed of trust type transactions. So in a note and deed of trust transaction, this is where the seller is actually going to convey title to the buyer, just like any typical kind of purchase where the buyer is going to get a loan from a bank. They're going to sign a promissory note at closing, and a deed of trust will be recorded on the property to secure the interest for the lender for giving that loan for the acquisition. So the note is the primary document in this, where the buyer has promised to pay to the seller, which is now what we call the bank. This is when I refer to when the seller becomes the bank. So the seller is now going to be the bank. Payments are going to be remitted, again, either to the escrow company or to the seller, just depending on how that is structured. When it's a note and deed of trust, this is when the seller owns the property free and clear. So they don't have any current debt on the property. In these situations, it is conceivable that the buyer can make the payment directly to the seller. But again, just to be professional, limit liability, escrow, I recommend the escrow company. And then the all-inclusive note and deed of trust is basically going to be the same thing as a note and deed of trust, but when there's a mortgage on the property. So if the seller selling the property is not going to pay off the loan that they currently have on the property with XYZ Bank or XYZ Credit Union, that loan, we're going to do an all-inclusive note and deed of trust. So in the note, it's going to be structured essentially the same way for payments as a typical promissory note, but it's going to reference in that note that there is a current mortgage on the property. And we're going to call that either the underlying debt or the senior mortgage. People like to use we love to use different terms in this business. It's what I call job security. We have 3 or 4 different terms for the same thing, so we can sound really smart. So we're going to use an all-inclusive deed of trust on this. And these are the situations where a payment to the escrow company is pretty much 100% necessary, because what the escrow company is going to do is they're going to receive the payment from the buyer, and they'll turn around and they'll make the payment on the underlying debt or the senior mortgage. And then if there's money left over, which we'll get into that money would be sent to the seller. So they're kind of the investor on the transaction, and the escrow company is the servicer of the loan. So this is going to protect both buyer and seller. That means the buyer has assurances that the seller's current mortgage payment is going to be made and kept current, because there are situations where if you don't set it up with an escrow company, that seller can just not make the payment. And then obviously that loan would go into foreclosure and the buyer would be in a real pickle. So escrow companies are very important when we're dealing with all-inclusive transactions. Some people will call this a wrap contract as well, just another term to throw out there. But again, this is set up like a typical bank would loan money if you're in a deed of trust type state. So this allows for a foreclosure, a different foreclosure process versus what we're going to see with the contract for deed.
And let's go a little deeper on that, Trent, because I mean, a lot of people, as fun as it is, we're so in depth in this that we're whipping out terms and terminology that other people may not understand. So escrow company, a great question was just asked about, okay, what is escrow? Is that the same as a title? And so even though that may be something that, those who do this every day, maybe pull it back a little bit, Trent, and talk about, okay, what the different states do have different terms, right?
Great question. Yes. So, an escrow company. So anytime we talk about escrow, we're talking about holding money in behalf of somebody else, right? Excuse me. In Utah specifically, other states may be different, but I would say that it's probably going to follow the same suit in that I work for a title and escrow company. The escrow work that we do is directly tied to the purchase and sale or refinancing of real estate property. So we are only going to do an escrow if we are issuing a title insurance product to go with the escrow. The escrow company in this case, when we're talking seller financing, now we'll obviously do all the title and escrow work for the transaction itself, but the escrow company is really, let's look at them as a private loan servicing company, and I'm calling them the escrow company. So they're a servicer. So like, for example, some popular ones out there, Mr. Cooper, New Res, UWM, they service loans. Now they also, some of them originate loans. Some of them, they buy loans from people that originate them, and then they service those, and they make money on servicing the loans. So they receive the payment, do what needs to be done with receiving the payment, getting it to the right people or whoever owns the note, And that is what the escrow company is doing in this case. So let's call them a private loan servicing company. Does that answer the question?
Yeah, I think that helps it. And once again, it's always fun to do these webinars with you. And you're my buddy Trent, obviously Mr. Title and Escrow to the rest of the world, right? But that's the thing is especially where we're doing this every day and we're seeing things and we're having things going. Sometimes we start speaking what we think is English, but is really Greek to everybody else, right?
Very true.
Now Dale brings up a great point. When you're talking about the different types of loans, right? He says the buyer's in trouble either way if they don't make the payment. And that's true. So kind of walk through, because I know that is a fear that a lot of real estate agents, their clients have. Okay, I could do seller financing, but what if someone doesn't make the payment? What protections do I have?
Yes, great question. So you're going to have, it's going to depend on the type of transaction. Let's start with contract for deed. If the buyer doesn't make the payment on a contract for deed, they are in default on their contract. And in different states are going to have different practices on what happens if you go into default on a contract. Typically here in Utah so actually I'm going to rewind just a little bit. With contract for deed, you're going to have to do what's called a judicial foreclosure if payments go missed for an extended period of time. So leading up to that, if it's a contract for deed situation, the buyer doesn't make the payments, then there's no notice of default filed on the property. That's for a non-judicial foreclosure, and that is what we do with a note and deed of trust. So in this case, you would have to notify the buyer. And this is another reason you would use the escrow company or private loan servicing company is they will send out notifications to the buyer that payment has not been made. You are in essence in default or violation of the contract, and procedures steps and procedures will begin taking place to do the foreclosure if the payments are not brought current. Okay. So in a contract for deed situation, it's a judicial foreclosure, meaning it's going to go through the court system to be completed. So you have to have an attorney represent you if you're the contract beneficiary, you were the seller on the transaction. You're going to have an attorney represent you. That's going to go through the courts. A judgment would be rendered. You would have to do an eviction. Here, like I said, I can only speak for Utah, but you use a sheriff's deed to do a foreclosure. And the time frames on that are going to be different. There's different redemption periods for judicial foreclosure procedures and non-judicial foreclosure procedures. So in Utah, typically a judicial foreclosure process takes about 6 months. A non-judicial foreclosure process takes about 4 months. And they're different in the processes and procedures. Now on a note where you have a note and a deed of trust, and it's going to be the same for whether it's the note or the all-inclusive note. In this case, when the buyer doesn't make the payments, you file a notice of default on the property. From then, there's a redemption period in which the buyer can bring the note current, or if they're behind 2 payments, they can make those 2 payments plus interest plus penalties, and the loan is now brought current. It's no longer in default. So they have that redemption period, and then after that, there's typically a publication period in which the foreclosing attorney can publicize the trustee's sale. And this is the kind of thing what you see when people are bidding for property at the courthouse or whatnot. That's typically with a non-judicial type foreclosure. So there are things put in place to protect the seller in the event that the buyer does not make the payments. We want to structure this in a way that protects equally the buyer and the seller. We don't really want to favor one over the other, because Our job as a title and escrow company is to be a disinterested third-party fiduciary. So the way we're going to structure a transaction is it's going to be based on what the contract has been signed and the terms and conditions agreed to in the contract. But then we're going to put the paperwork together so that everybody has their proper protections in the event of a default.
Now, what about in the case, so in a non-judicial state? Latrocia asked a great question. Says, so in a non-judicial state such as Georgia, will you just publish it in the local county paper? Walk us through, kind of the 30.
That is one place. It has to be posted. It has to be posted in a public area as well. And it also has to be posted on the property. So and every state may be a little bit different on what their publication requirements are. You can check with you can probably Google it. You can check with a foreclosure attorney in that state. But in Utah, it's essentially posted in the newspaper, posted in public areas. I think there's 2 or 3 places. I don't do foreclosures specifically, so I don't know all the details. But then you have to post a notice of trustee sale on the property itself. So there are specific requirements to do the publication, and that has to run for usually 3 weeks.
Well, that's the beauty, Trent, working with someone like you, not to do a plug or anything, but the company that you work with, what's the name of it? Some of you may have heard of it, right?
I'm employed by Old Republic Title.
And so if people were to reach out to you, at the very end, we're going to show all of your socials and everything like that. If they were to reach out to you after this, in the case of Mark's hopping on a train in a couple minutes. Yes, a recording will be available of this. You can locate it. Go to wrenews.com, click on webinars, and it will be available afterwards, the recording. It's also shared on YouTube. It's shared on LinkedIn Live and Facebook as well. But yes, Mark, don't stress out. You can go back to this. So ask your questions and then come back, right? Try to glean as much as you can. But in the case of if someone has a question and they reach out to you, and let's say it's a state that you can't do for whatever reason, would you be able to refer them to an escrow agent? Would you be able to help answer their questions? Kind of walk through that, because there's a lot of information here. Okay. People are from all over the nation.
Yeah, absolutely. So my job is, I think most of it, everybody knows, this is a relationship business. And my job is to build relationships and to help wherever I can. Most of the times from title company A to title company B, the difference is the type of service that you're going to get and the expertise that title company has. That's really what I have to provide to my clients, is my knowledge and expertise. I sat down with an agent. He just got his license in February this year, so he's very new. And I was telling him about all the types of transactions that I specialize in, and he was super excited because he's like, I don't know anything about seller financing, 1031 exchange, remote online notary. He's like, I don't know anything about these. So he was super excited that he has someone to attach to and get that information from. Now, if you're out of state, I'm more than happy to connect you with a good escrow title company in the area that you're at. You know, if it's, obviously I would be looking within the Old Republic Title network first. Yeah. And then from there, Old Republic Title also, they're a national underwriter, but they're also an underwriter for independent title agents like I used to be. So, you know, if it's an attorney state, that attorney is going to underwrite their closings, their title policies, with an underwriter. And if they're an underwriter if they underwrite with Old Republic Title, then we can branch out to that network as well. Mm-hmm. So we've got a lot of people that we can get people referred to help them with their local issues. And I'm more than happy to have a conversation with someone over the phone and go over these specific things, even if they're not in my state, because I'm a big believer in what we call giver's gain. What I give to you, I believe it will, in the universe, it'll come back to benefit me in some way, shape, or form eventually. So the more I can give, the more I believe that I will receive.
I love that. I absolutely love that. And you really are that way, for what it's worth. So Latrocia brings up another great question. Thank you so much. So really, I mean, the point of this webinar today, you've gone into really meat and potatoes. We pulled back a little, gone back in. But what are the pros? And I think let's talk about today's market environment, because sellers financing when rates were 2.5 doesn't really make sense. Would you agree? But in today's environment,
Yes and no. I would agree
Yes,
for
yeah.
the most part. Yes.
Yeah.
Yeah. So, Rick, if we can pull up the next slide, we've got a slide on there. Yeah. So this is to help me kind of guide me through the discussion.
Which helps
a little
answers
bit.
Michael's as well question. He's like, great information, but how do we implement to increase listings?
Yeah.
So here you go, right?
Exactly.
2 questions with one slide.
So let me give you a little bit of an example before I kind of dive into this. So when I was selling my personal home back in 2019. And this was before, obviously, COVID, before things kind of blew up during that year. We were struggling to get it sold. It was a very unique house, beautiful, loved it, but it was unique. And I knew that it wasn't going to fit every buyer's need. And so one of the things that I did, it took a little bit of convincing with my spouse. And I said, honey, we need to try and sell this seller financing. That's going to open up our buyer pool from this to this, because there are certain people that are looking specifically for seller finance transactions. Mm-hmm. Within a week of putting it in on the listing service as seller financing as an option, somebody showed up on my front doorstep and wanted to talk to us about doing seller financing. So it definitely increases your buyer pool. So the main thing, and I think right now in the market that we're in, obviously rates have been high, right? They've been in the low 8s, high 7s. I think we're getting, I'm hearing rumblings of people getting in the 6s on interest rates. That's still too high for some buyers with values where they have gone to over the last 3 years. So the benefit with seller financing is you're going to have negotiable terms on the sale. And the main thing that's going to be negotiable is the interest rate. And so where you're looking at people that bought really from 2011 to 2022 up in, before 22, before the interest rates went up, they've all mostly got low interest rates. We're talking 3, 3.5, 4, 4.25. So with those lower interest rates, it really gives the ability for that seller to turn around and sell it with seller financing and do a couple things. They're again, the main thing is to widen your pool for buyers, okay? Mm-hmm. Because you're going to be looking for, if we jump down a little bit on that slide, stay on that slide, you're going to be looking for self-employed buyers or real estate investors. They love these because there's no underwriting done with the bank or the retail lender.
So is this affected by Dodd-Frank? Like, is there a limit on investor seller financing? Is there a limit on you having your properties be seller financed?
No, nope. None of that is deals with Fannie Mae or Freddie Mac or Dodd-Frank, any of that. So you can, that's why investors love them, is because they don't have limits on these because they're private loans.
The investor buying, to be clear. Yeah.
Yeah. The investor can go buy 10 of these and have 10 of them on the books if they want to. And they can negotiate their terms, where usually if you go to a bank, you're not negotiating terms on your loan, right? They're giving you the terms. Seller financing is you are going to negotiate the terms. And one of the things is, like I said, the interest rate, you can negotiate. So I do a fair amount of seller financing closings. Right now, most of them are in the 5% interest rate range. So that is saving the buyer money on their monthly payment. You can also just negotiate the amount of the down payment due at settlement, whether it's a balloon payment or it's a full 30-year loan. I'd say most seller financing is going to be in that 2.5 to 5 year term on the loan, and it's going to have a balloon payment come due. So That's the standard. But I've got 2 or 3 of them that I've done lately that it's a 30-year mortgage, and that seller is willing to carry the loan for obviously the full 30 years. They have to. That's the agreement. So they're going to get their payment on their equity on a monthly basis over the next 30 years. So obviously this isn't going to work for every single seller. In real estate, there's no one solution, right? To fix everything, to get everything. This is just another tool that you can use to sell the property if you've got a property that you're struggling to sell. You may not want to do this right off the bat, but a discussion with your seller would need to be had is, hey, this is one option to sell your home, is seller financing. The thing to keep in mind with this is if the seller has a mortgage, that mortgage is not going to get paid off. It is going to still show on their credit. So that you typically need somebody that can go and get another loan on a property that if this is their primary residence.
Mm-hmm.
They need to go get another loan for their primary residence. They need to be able to qualify for that new loan without paying off this loan. And some underwriters on that new loan will take into account what they're receiving on the seller financing payment, but that's going to be a decision of the underwriter on the new loan. So that's a discussion that should be had with that loan professional when applying for that new loan. So that's the big thing, is when you're listing, you're expanding your buyer pool and you're able to negotiate terms.
And that's the nice part. In fact, when we were advertising this, we had an email come in, and I shared this with Trent. There was an agent who said, I can't actually make the webinar, but how did he put it? He says, I don't normally respond to these emails, and make comments, but he goes, this is very timely. There were 3 homes that he sold this last month that had to go seller financing and would not have sold had it not been for seller financing. So let's zoom that back up to pull the helicopter back up to 30,000 feet, right? And look at it from there. If this helps you sell 1 more, 2 more, 3 more homes in a year, what does that do for your lifestyle, right? How does that help? So getting back down into the grass now, we're flying back down. So let's see here. Michael has a great statement. He says, so this can help with listings that are languishing on the market. And yes, he goes, I have one that has been challenging. Exactly what language do I put on the listing with regards to seller financing? And so I know you're not an attorney, Trent, but have you seen?
I would just put on their seller financing available.
Okay.
And if they've got a mortgage on the property, you may want to speak to your broker in regards to what exact verbiage he would want on there. But I would think seller financing available. If there's a mortgage, then it would be whether it's contract for deed or all inclusive, note and deed.
And obviously they can contact you for any help like that. You can get, someone local, or if you can do it. And obviously, like I always recommend to every real estate agent out there, do not mention interest rates. Leave that up to the loan officers, right? Because you do not want to have any issues that way. That does cross, Trent, if I'm understanding correctly, you're the Mr. Title and Escrow. But if a real estate agent were to put under seller financing interest rates and things like that, does that cross a legal line? Going back to that whole Dodd-Frank.
Oh, that's a really good question. I've never been asked that question before. Probably a discussion to have with your broker to see what their comfort level is on it. I'd probably stick with seller financing available as opposed to a specific interest rate.
Perfect. Craig brings up a great question. He says, so basically the seller's offering a loan to people who wouldn't normally qualify for a loan at an interest rate that is lower than what banks offer. Mm-hmm. Now, he's asking, how is that a good thing for the seller?
Well, let's look at it from an investment standpoint. So let's say the seller has, for easy numbers, $100,000 in equity on this. So when they sell it, they're not going to get paid. They'll get a portion of that equity depending on what kind of down payment is negotiated. But let's say, again, for simple math, there's 0 down payment, or at least that whole $100,000 of equity is going to be deferred into the seller financing payment. If the payment is negotiated, let's say it's a 5-year balloon on the seller financing. So for the next 5 years, the seller is going to receive monthly payments of principal and interest on the $100,000 portion. And they're getting an interest rate of, let's say it's 5.5%. So that's going to be, let's see, so 100,000, just running some math here real quick, times by the interest rate. That's $5,500 a year in interest on that $100,000. So over the next 5 years, they could make roughly an extra $20,000 to $25,000 on the sale of that real estate by having done seller financing. So this is one of the strategies, is to make more money from your sale. Now it's not going to be huge, and obviously it's going to depend on the loan amount, the interest rate, varying factors, but in essence, they will make more money on that sale. That's the first thing. The second thing is, the benefit is to open your buyer pool. You're going to get more buyers. And then the third thing, this doesn't apply in every case. Maybe you're selling an investment property. And if you sell that investment property and you've elected not to do a 1031 exchange, we can get into, obviously we need to do a 1031 exchange class. But the seller wants to take the money from that sale, all of the capital gains. But if they took it now, they're going to pay crazy amounts in taxes. Maybe they're going to take this 100,000 and it's going to put them into the next tax bracket that they're going to pay higher taxes at. If you do seller financing, you're going to spread that capital gains over a longer period, whether it's 3, 4, 5 years or more. Again, depending on the terms agreed to in the contract for the seller financing, you're going to spread those gains out so you can keep yourself in a lower tax bracket. These are things you want to talk about with your CPA. Obviously, I'm not a CPA, not giving any tax advice, but that is another reason to do it for a seller.
And Arthur brings up, he says the seller has many tax benefits on the carryback, and you know, Trent, obviously, I mean, that's what you were just explaining. It's great. And so going up here, there's another great question, Trent, that I have. I just want to make sure I find it here real fast. How do you deal, George Presley says, how do you deal with the due on sale clauses when you are buying subject to and the title transfers to the buyer?
Yep, great question. That was definitely one thing I wanted to address. So
perfect.
Due on sale clauses. Most loans, in fact, I couldn't tell you a single loan that does not have a due on sale clause. So that is usually people's main concern. What are we going to do? If you sell it, I understand that they're going to call the note due. So in my experience, I've done these for 24 years. I've only had one single loan where the note was called due from the sale. Now, obviously, I've only got my experience. Other people are going to have experiences where the note was called due. So here, my 2 cents on the matter.
Yeah.
You know, the gospel from Trent. So typically, the lender is only going to call that note due if there's some sort of prepayment penalty on the loan. Most of the time, if you do the seller financing, the sale's gone through, as long as those payments continue to get made on that debt to the mortgage company, the underlying or senior mortgage debt, they're not going to call the note due. There are a lot of rumblings out there nowadays that lenders want to prohibit people from getting lower interest rates than what is out in the market. So, of course, the rumor mill is that there's going to be more due on sale clauses. But I've talked to certain attorneys that I know, and they actually think that lenders are going to be more lenient on it. So it just really depends on who you're talking to. But what we do in the paperwork is there is specific verbiage in the paperwork that says, in the event that the due on sale clause is enacted by the underlying debt holder or the senior loan note holder, it is then the buyer's responsibility to pay off the loan on the seller financing. They typically will have about 45 to 60 days to do that. And to do that, they can sell the property, they can refinance the property with the bank, credit union, retail lender, etc. They can go get a private loan, hard money style loan to pay off the loan. And then, it is kind of a bridge loan to get a long-term loan with the bank, credit union, or
so essentially they need to add that
lender
into the contract then. If the note
that is in the note and the contract. It's actually in a few different places within the paperwork to really cover our bases. But again, if you've got a situation where it's again, there's a prepayment penalty on that note, or it's some sort of grant program. The one loan that I saw called due was because it was a very specific program with the city, and there was a grant given to the buyer to buy that property. And the requirement of that loan was they had to live there for 10 years as their primary residence, or they had to either pay the grant back or they had to pay the city a portion of the equity gain. So when they sold it, we actually told them, I wouldn't recommend doing this, but they wanted to, so we let them do it. They signed the proper disclosures, and within 6 months, the bank called the note due.
Gotcha.
And it was kind of one of those talks my wife has with me all the time. I told you, but it's rare. It's rare. If they're owed money, they're probably going to call it due. But I close hundreds of loans every year. I hardly ever see prepayment penalties. I haven't seen prepayment penalties for the last few years, really at all. They're only on very specific loans.
Now, speaking of those specific loans and the hundreds you've done, well, real fast, Dale had, and I want to get to Ferdinand's in a second, but Dale, so if the note is called, does that nullify any of the other terms of the all-inclusive deed and trust? Just if you can briefly touch on that.
No, it doesn't nullify it. It just enacts that clause in the contract that the buyer is now required to pay off the loan.
Okay.
Because the seller, who is now the bank, the lender, the seller has to pay off that loan. So they have to get that done or they're in default.
Gotcha. Perfect. So there are protections, obviously. Once again, Dale, to answer that, if the note's called, the contract states that the buyer has to do that. Okay. Ferdinand had a great one for owner financing. Are there terms that are not permitted for single family home sales? So is there something that you're not allowed to put in there?
Not really. No, I mean, sky's the limit. That's always what I tell people. Sky's the limit. You can get creative on your terms. Sometimes people try to get a little bit too creative, and it's like, okay, we make it work, but my job is to take instructions and put together the paperwork for the closing. So
make it work.
If whatever terms they come up with, like if somebody gets someone's dog in 12 months, they get to have the dog with the house, they could certainly put that in there. I mean, you can get real creative, but people usually kind of stick to the standard monthly payment, principal and interest, taxes and insurance included. Buyer is responsible to pay all of that.
And no one's asked this question, but I'd be surprised if nobody's thinking this, Trent. Okay. So in seller financing, obviously real estate agents, they do a lot, right? I mean, they really, to earn that money, they work tirelessly. And I have the utmost respect. I mean, nights, weekends, holidays, because that's when buyers are available, right?
Yeah.
And so that's when they're working, and so in seller financing, how does an agent, this is me, okay, once again, no one's asked this question. This is John asking this for all my friends watching, okay? How do they ensure they still get paid in a seller financing situation?
Oh, great question. So typically, they're going to get paid at closing, just like they would in any transaction.
Okay.
It's going to depend on a couple factors. Number one is how much is the buyer's down payment? So is the buyer bringing in enough money? Now, let me rewind. I'm talking about an all-inclusive deal here, right? Where we're not paying off the seller's mortgage. So they're really not planning to get paid a lot of money, right? Because they got it all tied up in the mortgage. So if the down payment is big enough to cover closing costs, commissions, etc., then the realtors get paid at closing, and the seller would walk away with some money as well. In my opinion, to make seller financing work, there should be a benefit for the seller. They should be walking away with some money and the ability to pay their closing costs. If that's not the case, the agents would get paid. Again, it's negotiable, but standard practice is they would get their commissions, either a portion up front and then a portion when the loan is paid in full, or they would get all of their commissions when the loan is paid in full. It would be worked into that payoff structure.
So let's go down the rabbit hole here for a second. And yes, by the way, Ferdinand, anybody else asking, all of his socials will be available at the end of this show here, so you can contact Trent, Mr. Title and Escrow through social media and everything like that. And for everybody, again, this will be, if you go to wrenews.com, click on webinars, and then you scroll down, you'll have all the webinars. This one included will be there. So you'll have that information. Thank you, Rick, for pulling that up. Just tap, it's its own tab, webinars. Great question. I haven't thought about, but let me go back to it. Let's see here. Sorry, a whole bunch came in. George Presley asked, I believe that neg am loans are not allowed. Is that correct? I mean, it's seller financing. They have their terms. Are negative amortization loans allowed by a seller financing? And I'm going to bookend that with another question. So if you can answer both of these, Trent. Does Dodd-Frank require, and this is George as well, actually. Thank you, George. Are sellers, do they have to verify because of Dodd-Frank that the buyer has the ability to pay on a seller financing? So two questions: ability to pay, and are neg am loans allowed?
Neg am loans are allowed. I've never done one. I've never had a seller willing to do a negative amortization loan. I don't see any reason why you couldn't do one, though, because that's negotiable terms. Negative amortization loans are done with, as most of you would know, reverse mortgages. That's how reverse mortgages work. And those are completely legitimate loans. They're excellent loans for specific transactions. So I don't see any problem with doing a negative am loan with the terms on the seller financing. And then the other question is, you don't do any type of, there's no Dodd-Frank. I mean, we got requirements that the title and escrow company is going to abide by with Dodd-Frank and CFPB with their closing practices. But as far as lending, there is no Dodd-Frank involvement with a seller financing loan. We don't use a closing disclosure. There's no loan estimate. It's all done with a settlement statement. So
I love this, Latrocia, and I apologize if I'm saying any of these names wrong. That's 100% on me. But Latrocia asked a great question. What about if there's a death? Okay, so you've done, and I know how you're going to answer this. You have three different types, right? 1, 2, 3 of the notes you're doing and everything like that. So if there's a death of the owner, but the buyer's name's not on title, is that something you see that people require on paperwork? Like, how do you protect that buyer from, you knock on wood, something happening to the owner who's doing seller financing?
That's a spectacular question.
Yeah, I love that.
That's going to be a lengthy answer. So, but I'm going to summarize this. So, my recommendation, and this is total personal opinion. Everybody has their opinions, right? My opinion is stay away from contract for deed. I typically focus on all-inclusive note and deed of trust for the seller finance transactions that we close. If someone wants contract for deed, we're happy to close it that way. But in my opinion, the note and all-inclusive or note and deed of trust style protects both parties equally as opposed to a contract for deed. I believe the contract for deed heavily favors the seller in a transaction, and you can make great terms and a great deal with note and deed of trust. So in a note and deed of trust situation, you would avoid that problem because the buyer is on title, and it's not really the buyer's concern who the beneficiary of that note is. If the original beneficiary passes away, it would fall to their heirs. And if payments are being made to the escrow company, the private loan servicing company, they would take care of that with the beneficiary's heirs. So the buyer wouldn't have to deal with it at all. On a contract for deed situation, there is a deed that's already been signed by the seller to the buyer that would transfer title. So once that contract is fulfilled, that deed would get recorded. It should still work because the deed was executed before they passed away. We'd probably want to consult with some underwriters and attorneys in that situation to make sure. And if that's not going to work, we'd probably have to do a probate may have to be done. And a personal representative for the estate would have to sign a personal representative's deed as kind of a backup or fail safe for the deed that's currently held in escrow. That would be my guess.
Okay. And really what I'm hearing throughout this entire thing, and as I'm sure all of us get trading all the time, make sure you use a professional, make sure it's in writing, and make sure, get your bases covered there. By the way, Latrosha, she just said this has been a great webinar. Thank you. She says all of us, but I know she meant you, Trent. So
Thanks, John.
Seriously. And that's the thing. If you want to see Trent again, we're trying to tell him, hey, he needs to do this every month because the importance of what he's bringing to the table, the fact that so many people are trying to reach out to you. If you go to your last slide, right? Doesn't it have all your socials on it, Trent?
It does. Yeah. That little show up there was from my Instagram. Obviously, they're all just a little bit different.
Yeah.
How they all show it. So we kind of touched on that stuff there, but there's all my social media. Choose the one that you use the most, and you'll find me on there. Some are, funnier than others. Some have some extra stuff, but they get the nuts and bolts in there.
And yes, keep that up there, Rick, because some people are asking for his phone number. There's his website. You have everything there from YouTube up to Instagram. And one thing, like I said, I've known Trent for years and years on my personal properties. You know what? He's been great. If you live within so many hours, he'll actually drive out to your home. I shouldn't say that, right? But he's driven out and he's come to our home to sign when we haven't been available for us to drive out. It's really, it all comes down to, as Trent said, there are many people who offer the same product, but it's that relationship and it's the willingness to take care of problems, answer phone calls, communication. I can't tell you how prevalent that is. I'm probably the only one with this issue, but in today's day and age, people just answer their phones or make sure to call back same day, respond to text messages. It is so critical for business now, and especially all of you who are real estate agents. You have buyers who they're calling you. Okay, is there anything? You have sellers. Is there anything? Is there anything? To have a partner in place who will treat you like a partner is critical to the success, because in 2024, I'm telling you right now, with everything we're seeing, in fact, if you go to WRI News, builder confidence today, builder confidence rises for first time in 4 months. Fannie Mae forecast home sales and mortgage origination recovery in 2024. You have the fact 21.8% increase in new home purchase mortgage applications. I hope everybody has heard that. 21.8% increase in new home purchase mortgage applications.
Wow.
Everybody should be jumping up and down, high-fiving, right? That means people are now actively looking for new homes because they're taking those applications. They're getting qualified. And for those who don't, and back to a previous question someone asked, I just want to really, really drive this one home. This loan, seller financing, and Trent, add your color to it, but this is not for people who don't qualify. You have individuals like myself or Trent or whoever who they want to go out there. Seller financing is sometimes a better way to buy a home because now you have the loan with the individual instead of a loan with a bank. And so it enables you to be able to borrow more, to go out and get bigger projects, and to expand your, whether it's your own personal sphere of ownership or for your clients. I don't know, Trent, if you want to maybe end on that note on, is it truly for people who don't qualify, or is it something that is a powerful tool? And obviously I guess I'm leading the direction. That's why I'm not a
Yeah, I mean,
just here hanging out. So
for people that don't qualify, I mean, possibly if the seller's willing to take the risk on that buyer, they would want to do their due diligence where they can. But, seller financing can be anywhere from that kind of buyer, really more ideally people that the predominant people that I see doing it are self-employed investors, people that just don't, they're limited on how many, I mean, I'm not a loan underwriter, but they're limited on how many loans they can have.
Correct.
For investment properties, right? So this is a way to go and get additional investment properties if you've hit that max. So, the one thing that I say is, as a real estate agent, as a title and escrow professional, the more tools I have in my tool belt, the more I can take care of my clients. And as a realtor, I would assume that the philosophy is similar. The more that the more tools that you have at your disposal when you're sitting down with a buyer or a seller to help them with their real estate needs, the better off you're going to be. And really, it's obviously that I'm always dialed in, focused on that transaction. But when that transaction's done, what are you looking for? You're looking for referrals. And that's how you're going to get referrals, is if you were overly helpful for them. If you were just kind of like doing the run of the mill, you may or may not get a referral from them.
I love that. I love that. And yes, Arnold and others, reach out to Trent. They're asking, do you know an escrow agent in Memphis? Do you know one in Michigan? Reach out to Trent and he can help you find someone. He can help you with that. But I'm going to end on this note. You have a great question here from Jim Morton. Hey, Trent, is that a Leroy Neiman over your shoulder? The painting.
The painting. I don't know who Leroy Neiman is.
Oh, no.
Admittedly. So I'm a big sports nut. If you look at it closely, that is the oil painting from Rocky 3 with Rocky and Apollo at the end where they do their little private boxing match. That's the oil painting.
Gotcha. Okay. Well, I appreciate it. And Trent, thank you again. And hopefully everybody, if you want to have him back next month, let us know. Reach out to Trent and tell him, because like I said, this is something that we always want to make sure we're providing something of not just interesting, but of incredible value to you over here at Weekly Real Estate News. So whatever we can do to help out.
And if I can put in a plug there, John, that's what my social media is it's education focused. It's 1-minute videos typically on little tiny things that we're involved with the title and escrow side that just explain it, because most people just don't really dive into it. So,
well, thank you, Trent. And as everybody else knows, you, Mr. Title and Escrow. I'm not going to call you Mr. You're always Trent to me. So thank you so much for your time today. Thanks, everyone. Rick, anything else you want to add? I'll translate for everybody saying, no, it was a great show and we love everything. And
yeah, well, it helps if I unmute myself. You guys did a fantastic job today, as always, Trent. We can't wait to have you guys on again. If you guys are not taking out for the holidays yet, we've got another webinar coming up about this time tomorrow. You won't want to miss. You'll find out more about that and everything we do on Weekly Real Estate News. Until next time, guys.